Good afternoon, everybody. We're going to get started just a little bit early. Ian has a lot of things he wants to talk about. So, looks like folks have mostly finished lunch. My name is Todd. Welcome to the next talks. And just a reminder, these talks are sponsored by the Innovation Advanced Technology Group. They provide the food, help me find the speakers, and I appreciate your support. I also want to say a brief message for the folks online. I apologize for the audio issues we had last week. We were in a new room and had a lot of problems with the microphones. So thank you for your patience, everyone online. We're trying to make things better for you every day. All right. So I'm very excited about today's talk. Ian Panchèvre is a product manager in Innovation Advanced Technology Group. And he joined us a year and a half ago to work specifically on on blockchain. Ian graduated from Yale, and one of the things he did as his thesis was write a 100-page paper on the blockchain and politics. So please join me in welcoming Ian Panchèvre.
Thank you, everybody, and thank you, Todd, for the introduction. So again, my name is Ian Panchèvre. For the last year and a half, I've had the great pleasure and privilege of being a contributing member to Intuit's blockchain initiative. And in that capacity, I've gotten to learn a tremendous amount of developments that are happening in the blockchain space, with cryptocurrencies, with crypto tokens. And I'd like to share some of those insights with you all today. So this conversation is not going to be about the price of Bitcoin or Ether or any particular cryptocurrency. I'm not offering investment advice, although if you'd like to chat, I'm happy to share my opinions offline. That said, even though I'm making that disclaimer, I do want to start by meditating a little bit about what's been happening in the cryptocurrency markets lately. So this is an article that was published in the New York Times back in January, and it's a really amusing article to read. I would encourage you to check it out because it's filled with hilarious anecdotes of individuals who suddenly found tremendous fortune because they bought Bitcoin and Ether early on, and now they're worth millions of dollars on paper. I noticed that the date of this article was January 13th, and so out of curiosity, I went back and I looked. This is what Bitcoin's chart was as of the publication of that article. So in mid-December of 2017, Bitcoin peaked at just under $20,000, which is pretty astronomical considering that it started the year at 1,000. And we were at this point in the process of a healthy 30% pullback in the price of Bitcoin, which if you're familiar with this market, that degree of volatility is very normal. We're still very much in a parabolic channel. So there's a lot of people that were, sharing charts on the internet that were projecting that Bitcoin was going to go to 30,000 or 50,000 as sort of the next leg up in its parabolic trajectory to a million. Unfortunately, that did not come to pass. I think you guys know what the next chapter in the story looks like. So this is Bitcoin more recently. Clearly, the bubble has bust. We've now pulled back, around 70% or so into the high 6,000s. Who knows what's in store for the future? Some people predicted it's going to go lower, down to 3,000. Other people think we're finding a floor right now. But one thing that's interesting about this chart is that it actually looks really similar to this chart. So this is the NASDAQ during the late 90s and the early 2000s. So just again, for comparison, this is Bitcoin today. The scale is different. This is over the course of the past few months. And here's the NASDAQ over the course of the past few years. Now, I don't have strong memories of this. I was about 10 years old when the NASDAQ was peaking. I'm sure some of you in the room might, were participating in this market at the time. But of course, this is not the end of the story either. Because if you were buying internet and computer stocks in the late 90s, you weren't wrong to bet on the emerging internet economy. You probably intuited that this technology would disrupt existing business models, it would create new markets, and it would fundamentally change the way we behave and the way we organize ourselves in civil society. And it turns out that the market ended up agreeing with that prediction. This is the NASDAQ performance thereafter. So now, quite recently we reached an all-time high for the technology industry. We're again in the process of a pullback. Who knows what's going to happen? But we live in a really remarkable moment in human history, which is that for the first time ever, the 5 most valuable companies in the world are all technology companies. So the usual suspects, right? Apple, Amazon, Microsoft, Alphabet, Facebook. These are the top 5 most valuable companies. They are American technology firms. And it wasn't too long ago when the most valuable companies were industrial giants or retailers or banks. And companies like ExxonMobil and Wells Fargo and Walmart are still very valuable and important companies, but they've ceded leadership to the technology giants because these guys have conquered every industry they've gone after. And similarly, there's a non-zero possibility that we're experiencing a replay with crypto tokens and cryptocurrencies, that we've gone through a speculative bubble phase. Admittedly, they're not really delivering a tremendous amount of value in market today, but there's a lot of really smart people that think that something really interesting is happening with blockchains, and the sort of digital assets that are being powered by blockchains will once again disrupt existing business models, create new markets, and change the way we behave and the way we organize ourselves in civil society. This is not an endorsement of any particular currency. These are the leaders today. If you're buying cryptocurrencies in 2017, 2018, I don't necessarily think it's a bad thing to do. The real question is, how do you time the market? Which ones are you going to back? And that's not the subject of this conversation. But I wanted to start with this observation because I do think we're at a very interesting moment in time. And if these currencies are going to succeed, if they are going to earn their market caps today and set new all-time highs, they have to become usable. They have to deliver real-world value. They have to be used by consumers, by businesses, by financial institutions. So for the purposes of this conversation, I'd like to explore with you all, what could the world look like if these tokens and these crypto assets become widely deployed? What would the world look like if we had millions of different tokens in circulations, if we had a fully tokenized economy? So we'll switch gears there. Before I start to shed light on that particular question, let's pause for a moment and meditate on the nature of money a little bit, because I think it's important that we kind of sort of reframe our perspective. So economists argue that money itself has three essential properties. It functions first as a store of value. You should be able to hold onto it, and it should retain purchasing power over time. So typical stores of value would be precious metals like gold, real estate, private art, fine wine. These are things that we know there's going to be a market for that in the future. The problem with those types of items is that they don't function as a unit of account. So it's hard to, use a painting as, a pricing instrument in a commercial exchange. So what money does effectively is that it actually creates a common price that we can then exchange off of. And in turn, it fulfills its third function as a medium of exchange. So these are the three classic properties of effective monetary instruments. Through the course of human history, we've had a lot of different monetary instruments. So, initially we lived in barter economies. Cattle was probably, and other forms of livestock were probably considered the first form of currency. You've got, 3,000 years ago, you have populations in the Pacific and in the Indian Oceans that use shells as their currency. Metal coins started to be used in China, in Mesopotamia, in the Mediterranean about 3,000 years ago. The Chinese used leather money 2,000 years ago. 500 years ago, you would have Native American tribes that would use beads strung together on strings. These were all forms of money because people in those communities sort of bought into the collective fiction that money is and used it as stores of value, units of account, mediums of exchange. And now we live in an era, in a regime that's dominated by sovereign currencies, where the nation state has declared a monopoly on the right to produce legal tender in that country. It controls the supply of that currency through central banks. And it wasn't too long ago where in the United States, every time there was a dollar produced, that corresponded to a unit of gold that was held in America's treasury. Now we've sort of, we've unbacked the dollar, and so it's purely a fiat currency. It's purely declarative. But the point here is that humans are actually very adaptable when it comes to different forms of currency. And we're seeing that kind of experimentation play out on a whole new scale today. So what's wrong with the existing currency that we have? I recognize that speaking to an American audience, we might not really feel acutely the problems and the limitations of our existing currency, right? It's relatively stable. It's used as the world's reserve currency. Most of the people in this country are banked, so we have access to the modern financial system. But that's not the case for everybody else around the world, right? So the first issue is that we're sort of enslaved into a particular monetary model, right? It's an inflationary model where the purchasing power of our currency decreases over time, and it's controlled by central banks. Again, probably not that big of a problem for us here in the United States, but we're very much aware that in other countries, they're dealing with hyperinflation. There's reckless monetary policies that really erode the purchasing power of their savings. Another big problem with currency, with sovereign currency, is that it's not natively compatible with e-commerce. This is a debate I've had quite often with my colleagues in IAT, and there's people that don't really buy into this line of thinking. But my point of view is that we do have payments on the internet, right? We're using services like PayPal and Stripe and Venmo. Intuit has a little bit of a payment business as well. And really what we did is we sort of hacked on infrastructure onto the web so that we would go through all these gateways and intermediaries and end up extracting funds, on credit or from a bank account into elsewhere. And, it's a very messy system. It's inefficient. It's an expensive system. And it empowers a lot of these centralized intermediaries. In contrast, I will argue that cryptocurrencies are natively compatible with e-commerce. And I think that point will become much more evident as this talk progresses. There's deadweight loss in the market. So we have a very particular economic structure that's proliferated throughout the internet. So businesses online are either making money through advertising, so it's an attention-based, click-based economy, or they're selling something directly, so it's direct e-commerce. But you could imagine that there would be businesses that would prosper based off of microtransactions, where rather than sort of monetizing your attention, you're paying a small little, fee to read an article or to watch a video. And that's not really practical on the internet because the cost to move a penny online is more than the actual penny itself. So we have deadweight loss where there's all these economic arrangements and businesses that could proliferate on the web that just don't exist at all. We also have privacy trade-offs, right? So if you're doing, electronic cash, those records are maintained by the bank. The government could subpoena them and gain access to it. And if you do want to do private commerce, where it's done privately, you then enter a different problem. Now you're in a cash-based economy, which is private, right? A dollar bill is not going to betray its previous owners. But you enter the problems of counterfeiting, which is a form of a double spend attack. And finally, this currency, of course, is subject to confiscation, right? Your assets could be frozen, you could be blocked out of your account. So these are problems that maybe you and I haven't directly experienced. We indirectly live under this, and people around the world are very familiar with this kind of stuff. In contrast, cryptocurrencies are radically different, right? So first is they offer an experimental approach towards different economic models. Most of them have adopted sort of the Nakamoto deflationary model, where in the case of Bitcoin, you have a limited supply of 21 million coins. That makes it deflationary, which makes it very volatile. But we also see some experimentation around alternative economic models. There's some coins that are actually inflationary by design. So we can kind of unshackle ourselves from the existing monetary regime we live under. They are native to virtual markets. So one of the fundamental paradigms that I think people need to understand in order to understand blockchains and cryptocurrencies is that in the world of a cryptocurrency, the currency itself, a Bitcoin, is not an object or a file that you're sending someone else. Otherwise, it could be pirated, it could be stolen, right? It could be intercepted. Rather, what it is, it's just a claim on a ledger that someone owns a Bitcoin. And it's a claim that's recognized by the entire network of computers that are powering the blockchain. And as such, the transaction record or the history of ownership for that coin, its receipt, is literally the same thing as the object itself. So when we're talking about virtual markets and virtual commerce, where we're talking about virtual goods and services, we now enter a world where those can actually be delivered and fulfilled concurrently with payment as a simultaneous transaction. So we could imagine a virtual data market where data is the good that's being exchanged. And there's a smart contract that says, okay, I can provide permissioned access to this data set. I have this buyer who's deposited currency into the contract, and I'm going to concurrently exchange the two, right? So in this case, the currency itself is embedded into the fabric of the economic transaction. It's not bolted onto it, which is what we have currently with the web. Of course, one of the corollaries here is that it supports microtransactions. So these coins are divisible. Bitcoin is divisible into 100 million Satoshis, which is the smallest unit. So we could imagine a world where we're paying people a few Satoshi and they're making some sizable income off of whatever content they're producing. There's a diverse range of privacy models. So you have dark coins and privacy coins like Monero, Zcash, Dash, which are using a combination of mixing technologies and advanced cryptography to obscure the transaction history. Then you have sort of pseudonymous systems like Bitcoin and Ether, where they're not associated with literal identities, but you can sort of infer from the transaction graph kind of the nature of the market. And there's other cases where you have distributed ledgers that allow you to sort of permission access to your own information, so you can disclose yourself selectively to third parties. So we actually have a range of different privacy settings that we can adjust in this world. There's no double spend issue, so this goes down to the core sort of mechanics of a blockchain, which I won't really get into here. But effectively, you're trusting a distributed network of computers to ensure that when I send you Bitcoin, I didn't simultaneously send you Bitcoin, right? And it's resistant to censorship and confiscation. Again, this goes to the properties of having a decentralized network. In order for somebody to basically steal currency from me, the network would have to collude and kind of force that theft, but that would undermine the integrity of the whole system. It would debase the currency. And so for mature cryptocurrencies, they really are censorship resistant. Now, they do have their own set of problems, right? There's problems with managing the keys and the wallets. You can, have those stolen. They're extremely volatile, right? So they're not very usable for a lot of e-commerce stuff today. But this gives you contrast between cryptocurrencies and sort of sovereign currency that we enjoy. So why now, right? I mean, there's been plenty of instances in which people have sort of created their own money for their own networks, right? So monopoly money, casino chips, Chuck E. Cheese coins, right? These are currencies that exist in service of a game, of a casino, of an arcade. Obviously, they don't have any value outside of this context, but who cares? When you're in the casino, this is the currency you're trying to accumulate. What's different, of course, now is the blockchain, right? We have this technology innovation that provides an underlying technology protocol that allows us to securely store and exchange ownership claims to these digital assets, as well as to the operating logic of those assets without relying on centralized intermediaries. And that latter point is really powerful because centralized intermediaries can be expensive, they can be slow, they invade your privacy in the sense they know information about you that you probably wouldn't want to disclose. And they can be, prone to fraud or manipulation, or they could collude, or they could steal, right? So let's talk a little bit more about cryptocurrency tokens. Let's go into more detail here. So right now we're witnessing a really exciting time where there's just this Cambrian explosion of experimentation and new tokens that are going online. So this chart is a little bit outdated. It goes back to the end of last year, but the trend is, more and more tokens are launching every day now. There's at least 1,500 that are recognized. And they range, and we'll talk about the different variations. Tokenization, I think, is really, really important for a couple of reasons. One, it's actually presenting us with a new profit model, right? We now can build internet companies that aren't relying on advertising or e-commerce or SaaS, but are instead relying on tokenization. So the way this works is, in some cases, they sort of create all the tokens at once that are going to power their network or their application, and then they sell a piece of those tokens to investors, right? This is the initial coin offering model. In other cases, they spin up their own blockchain, and every block or so, they produce new currency, which goes into circulation, and they can divide how that currency is allocated. A large percentage goes to the miners, maybe some goes to a pool that finances development initiatives, business initiatives. They can give some to users. And so what's really powerful here is that some of these projects can actually, if they design the system correctly, they can create a positive feedback loop where the token value appreciates, which gives them more capital to further finance their operations, which allows them to further appreciate the value of their token, right? Now, as of today, we're in a bear market. I don't think we'll be in a bear market forever, so we'll see who comes out of that. But that's radically different, right? We've never seen this in the history of capitalism where you have enterprises that are literally producing and consuming their own capital. And the business model is to drive up the value of their capital. There's a term here that kind of describes this phenomenon. It's called cryptoeconomics. And so people that are studying this, some people are dismissive of the term, but if you have a background in economics and game theory and peer-to-peer networking, cryptography and math and governance, you would find some interest in this area of study. So it's starting to cohere as an actual discipline. Just as it's a disruptive profit model, it's also a disruptive business strategy. So for the first time, we're actually able to monetize the direct protocol of computers, right? So we know what a protocol is. It's a rule system that computers use to interact with each other. And the creators of the internet protocols, HTTPS, TCP/IP, didn't really directly profit from that protocol creation themselves. It was really the companies that built further up the stack, that build the services that we directly interface with, that have captured the value of the web currently. There's a school of thought that blockchains and crypto tokens will sort of invert that power structure and will allow us to monetize the base network itself, and therefore the network operators are going to acquire disproportionate value than those that are operating further up the stack. So to give you an example that might make sense, let's take email, right? So email is used by a number of different email protocols, IMAP, POP3, SMTP. And I would imagine that those are sort of open source contributions for the world, right? Like I would imagine that the creators, as brilliant as they are, didn't really directly profit from the creation of the email protocols. Instead, it was Google and Yahoo and Microsoft that build clients that allowed us to interact with that protocol, and then we're able to sort of monetize our attention that captured the value. Well, imagine if we had a blockchain that was running the email protocol, right? And there was a little token, let's call it email. And every time you wanted to send an email, you had to spend a token. In this case, those that created the protocol and reserved some of the tokens for themselves would have been immensely wealthy. And you could imagine that there would be a number of people that would have predicted that email would be a big thing. They should therefore buy as many email tokens as they can while it's still cheap, and then they offload it into the market as the price appreciates. So that's the kind of dynamic that's playing out currently. The other point that I'll make here is that it's a powerful innovation because it allows you to sort of build an ecosystem around whatever you're offering. And you can align the interests of a number of different stakeholders. So by distributing the tokens, either by selling them or giving them out or sort of rewarding people for their behavior, you can make, investors, partners, developers, the business itself that has custody of the project, your user base, they can all become invested in the ecosystem you're trying to build, and they all start to think and work like owners, right? So, Facebook's been in the news a lot lately, and there's people that are speculating we should build a decentralized alternative to Facebook, one that's owned by the users. I would imagine if that actually comes to fruition, there might be a token system there where people actually have an interest in this sort of economy and it's used to participate, and therefore there's a mutual interest to drive adoption of the network, but also the appreciation of the price. So when are they useful, right? I think they're useful. These tokens are useful to. If you're on BlueJeans, please mute. Thank you, guys. Thank you. So I think crypto tokens are useful in certain cases. They're not useful for everything, right? But if you want to align stakeholder interests, it can be useful. If you want to drive adoption by giving away these tokens, by building referral programs that allows you to earn more tokens, they can be useful. I think the primary purpose here is if you want to build a decentralized system where that there's going to be some nefarious or malicious actors that are going to join the system, and their interests might actually compete with the greater health of the ecosystem. And then, of course, if you have sort of a market problem where there are particular demands of the monetary instrument that are very unique from what dollars or say Bitcoin or Ether provide, right? So we could imagine that a cryptocurrency that's used widely by IoT devices is going to have very different technical properties than a token that's used to tip people online, right? Of course, these tokens are not appropriate for every use case. First of all, we have to recognize that there are very real trade-offs with these, right? At least as currently architected, the blockchains can be slow, they can be expensive, there's privacy trade-offs, there's usability problems in terms of managing keys and managing wallets. And of course, people are just misusing the tokens because, again, we're in this Cambrian era of just proliferate experimentation. So people are throwing everything against the wall, and the industry collectively is trying to figure out what use cases are most appropriate. So I always kind of raise my eyebrow when I see startups that have just like a normal web product and like, okay, we need to ICO and issue a token. Like, no, you don't. Like, if you're trying to do that as a workaround from getting VC money and getting sort of gullible investors, that's one thing. But if you can't communicate a clear value proposition for your token, this is probably an inappropriate use. Closed or trusted systems, right? So if your token doesn't need to live outside of your product or outside of your ecosystem, and the users trust the entity managing this product, you probably don't need a currency. So the example here would be a virtual game, right? If you're in Farmville and you're acquiring virtual currencies, there's really not like high cost. You trust that Zanga is going to keep the record honest and accurate. And you don't need to take those tokens outside elsewhere. And then, of course, non-specialized monetary systems. So there's a lot of startups that are launching their own tokens because they want to play the token game. And really, I think that they would really what they're doing is they're building a decentralized service, a contract or a dApp on top of Ethereum or some other smart contract platform. And my view is their business model should probably be just to collect as much Ether as possible, right, through transactions and not try to sort of pump up their own currency. So what's in store for us for the future? Who knows, right? It's very possible that we can't overcome some of the technical limitations, that once we start really wrestling with the trade-offs of these coins, we sort of narrow the addressable market, and we actually have relatively limited impacts. That's certainly in the realm of possibility. There's also a non-zero possibility that we end up living in a fully tokenized world where there's tokens for everything imaginable. And in that world, I would expect there to be millions of different currencies, of different tokens in circulation, not thousands or hundreds of thousands, but literally millions. And if that were to emerge, I would think we would have sort of a long tail of token offerings. So you could imagine a couple of dozen tokens that sort of capture major industry verticals, and those tokens could have market caps in the trillions, right? So the dominant store of value, which today is positioned to be Bitcoin, a smart contract platform, which needs a currency to power the contracts on the platform, maybe a privacy coin. So if there's any people that like to launder money in the audience, like that's the coin that you would want to use, right? The coin for IoT devices. So these are all huge markets that could be worth trillions. But when you go down the long tail, we start finding really specialized currencies that probably don't have a trading pair, that probably have very limited utility outside of a closed community. So you could imagine a classroom So Roger, one of my colleagues in IIT, we actually visited a classroom and we created an Ethereum token for them. And one of the students suggested that they could use the token in their English room, where they have to review each other's papers, and they want to have sort of a peer review credit system where if you review, you get a token, and you can use that token to buy reviews from your peers, right? Like in that case, the token has no value outside of the walls of the classroom, but in the classroom, it's the currency to manage this peer review credit system. A poker room, right? You could imagine, five buddies that get together on a Thursday night, they play poker together, they don't bet with dollars, but they want to have something at stake, so they launch their own token for themselves. Those are the kind of experiences you would find down the long tail. So there's a really, really immense diversity of token offerings out there. They have different technical properties, economic properties, different value propositions. They're trying to solve for different market problems. And in IAT, my team and I have worked to put together a token taxonomy, so a classification system of various tokens. Sorry, I've been talking a little bit. And so I'd like to share that with you all. This is not authoritative, right? There's no authoritative classification system. Certainly there's people that have published stuff online, and we're drawing inspiration and influence from that. But this is how we, divide the market. So what I'll do is I'll go through these one by one. I'll give you some examples you might be familiar with, some other examples that might sort of provoke your curiosity, and hopefully I can do this efficiently, and then we'll have time for questioning. So let's start, of course, with cryptocurrencies, right? So these are virtual currencies that have value purely because social actors recognize it, because there's a market to buy it, there's some consumption of it. Cryptocurrencies facilitate commerce on the internet. I put those four words in quotation marks because those are literally the first four words of Satoshi Nakamoto's Bitcoin white paper. So when he first presented Bitcoin to the world, commerce on the internet is what he wanted to solve for. Examples here, of course, being Bitcoin, Litecoin, Monero, a privacy coin, Decred, sort of a mid-cap project I'm really fond of that's thinking very seriously about governance. I think one of the best examples one of the best uses for cryptocurrencies might actually not be in traditional web e-commerce, but actually might be in sort of machine-to-machine economies. And this could include IoT devices, it could include artificial intelligences. But we could imagine that as IoT devices and AIs become much more autonomous in their behavior, that there might be a need for them to create markets among themselves. They can engage in commercial transactions with each other and use cryptocurrency as a form of payment. So I shared here a screenshot of a recent article. So recently it was disclosed that Ford Motor Company had published a patent application for a car-to-car crypto transaction system. And I found the timing of this really interesting because probably the week prior to that, we were having a conversation during one of our IAT lunch meetings about this exact use case. So we were talking about autonomous vehicles, and the thought was, well, what if they could use cryptocurrencies to sort of create a culture among themselves on the road? And the use case that we sort of theorized was you could imagine a highway with slow lanes that are going 90 miles per hour, and if you want to get on the fast lane that's going 120 miles per hour, you would have to load up your car's wallet with crypto, and as you pass all the slower cars, you pay them little tips because you're passing them, right? So if you're on your morning commute, you just accumulate some crypto on the way. And if you're in a rush, you got to pay for that privilege, right? It turns out that's the exact kind of scenario that Ford envisions happening with autonomous vehicles. So I think this is one of the great uses for cryptocurrency. Utilities, sometimes known as functional tokens, right? So these are tokens that are used to power network functionality. The classic example here is Ether and the Ethereum network. So Ethereum is building a globally decentralized supercomputer that allows you to process smart contracts, decentralized services, dApps, and Ether is the currency of payment in that ecosystem. So if you want to run a decentralized service, you need to deposit Ether to sort of incentivize the mining network to honor the terms of the contract and self-execute it. Other examples would include Filecoin, which is doing decentralized off-chain storage, Golem, which is doing decentralized off-chain computation. I want to sort of imagine for a moment a different type of utility token. I don't know if this exists. Maybe it does. If so, I haven't heard of it, but it could exist. Maybe somebody could build it. It would be a token for a babysitting cooperative. So in the far right here, we've got a screenshot of an article by the renowned economist Paul Krugman. He wrote this 21 years ago, in 1997. And he was making economic observations of sort of a real-time economic experiment that unfolded in Washington, D.C., where a group of about 150 parents had come together and formed a babysitting cooperative. So if they needed babysitters for a night, rather than hiring a nanny, they would just sort of rely on another parent who would then accumulate babysitting credits and could spend those credits to get babysitting services down the road from that co-op. And they actually issued their own currency. It was called scrip. And Krugman goes on to describe how you saw really interesting sort of supply and demand scenarios play out, where if you had certain nights where there was high demand for babysitters, like maybe Valentine's evening, you would have to increase the price of your services in order to sort of incentivize people to babysit on that night. And then, they would have a lot of scrip, and so they could go on another night, right? The story here is they ended up mismanaging the actual sort of inflation supply of the scrip tokens. And so a recession hit the cooperative and the whole thing kind of collapsed. So that's that. But I do think that like this could be a legitimate use for a utility token, and maybe we'll see that one day. Settlement tokens. So I'm not going to spend a ton of time here, but these are tokens that are trying to sort of enhance and supplement the existing financial system as opposed to trying to replace it or undermine it. And so they're tokens that are used to kind of lubricate financial transactions. The primary example here would be Ripple XRP. I'm a little dubious about Ripple because they have 3 different products. Only one of those products, XRapid, actually uses XRP, and the use of XRP within Ripple system is very limited. So I don't want to spend a lot of time here. Another one would be Stellar Lumens. They were a competitor to Ripple, but they've since kind of pivoted away from that. This video here is actually Stefan Thomas, who's the CTO of Ripple, and he has a really interesting demonstration of how they would use Ripple for an AI economy. So sort of a group of artificial intelligences working together on a task, paying each other in Ripple. That I thought was really cool. Unfortunately, we're not going to have time for it. So if you really want to see that, Slack me and I'll send you the link. Security equity tokens, sometimes known as equity tokens, most commonly referred to as security tokens. So the idea here is basically tokenizing a financial instrument. So taking any type of financial instrument, it could be private stock, it could be a bond, a derivative, and turning that into a smart contract that's then exchanged by different parties. What's insightful here is that the legal logic of this financial instrument would be hard-coded into the programmatic rules of it, so it could behave in accordance with sort of like the legal construct of that instrument. There's a number of companies that are working on this. They're more in the distributed ledger space that are kind of working, to enable this technology for Wall Street and others. So Digital Asset, R3, T0, Symbiont, these are the leaders there. The example I want to spend some time on is on the concept of tokenizing private stock. So the idea here is that literally every business has private stock, right? In some cases for small businesses, it's really straightforward. The one owner owns everything. Or maybe they have one partner who owns half, or they split it with their spouse or whatever. But if you're a business that anticipates multiple rounds of funding, if you want to sort of leverage your stock to acquire talent, you start to develop more complicated ownership structures. You build out a cap table, which is just literally an Excel spreadsheet that like line by line tracks all of the stock transfers and shows the ownership structure. And this can get very complicated very quickly. People can make honest mistakes. People can defraud their partners through that process. We could imagine an alternative where tokens are used to represent ownership units in a business, and the movement of those tokens effectively sort of updates the cap table in real time. So it's secure, all of the stakeholders have shared visibility in the ownership structure of the business, and it's all programmatic, so that the logic of different classes of stock, whether it be voting rights or dilution preferences, would all be automated into the execution of the tokens. So that's a really cool use case. And if you guys were at the Next Talk 2 weeks ago, Andrew Tignau, the former director of the Delaware Blockchain Initiative, she spoke a little bit to this. So there's some real activity happening here. Asset tokens. This I think is one of the coolest ones. So the idea here is basically you have real world physical objects that need virtual representation. So you tokenize them by creating a virtual avatar that represents those objects in the virtual space. So this could include things like gold and diamonds, wanting to sort of track the origin and the provenance of precious metals so that we know that it didn't come in contact with child labor, or didn't come from sort of like illegal war zones, right? Real estate is a very popular example. Supply chains, right? So you have a lot of different parts flowing into your supply chain. Being able to tokenize all of them will give people sort of a real-time view on where they are. You can extend that up to trade finance and a lot of cool stuff. The one example I'll give here is private art. So Look Lateral is a startup that did an ICO recently, and they want to tokenize ownership in art. And so what they've built is a tagging system so that artists can sort of append a physical tag to an art piece, then register that onto the blockchain. So you have authenticity that from the origin of creation, this is the artist's authentic work. Then you have provenance of the ownership trail of that art piece. And then eventually that art gets posted on FIMART, which is the financial market for art regulated tokens. And so that's a market where people can then can use their Look token to buy fractional ownership in the art. So, that's cool because it makes the asset class much more investable for people. So, in my case, I could never afford to buy a Banksy, but would I buy a fraction of 1% of a Banksy as an investment? Like, why not if it were easy to do? You can imagine scenarios where, an art gallery owns 51% of an art piece, so it has the right to display it in the museum, but then the public buys the other 49%, and, there's sort of a promise to the public that 10 years down the road, we're going to sell this piece, and everyone's going to have a liquidity event. So that's an example of an asset token. Membership tokens. So these are tokens that unlock special privileges or rewards in a community. And typically the reward model is structured in such a way where the more tokens you have and the longer you hold them, the better perks you can unlock. If you're trading altcoins, you might be familiar with Salt or Dragon. I would classify those as membership tokens. The one example I would like to provide here is the idea of celebrity tokenization. I think this is probably one of the most fascinating things that people could do. But what if celebrities issued their own tokens, right? And they gave them or they sold them away to their fans. And it was then the celebrity's responsibility to create a market for those tokens. So they would post prizes and rewards such that you could redeem those tokens for signed memorabilia or discounts on a show, or maybe like priority purchasing rights or a 3-minute phone call, right? Like there would certainly be a market for people that would want to buy a 3-minute phone call from Taylor Swift for their daughter's 15th birthday, And my view there is that just as social media has created sort of a direct communication channel between celebrities and their fan base, tokens could create a direct commercial channel between celebrities and their fan base. Sure enough, someone's doing this. So this is GCox, which I think is the global coin online exchange. And they're working on celebrity tokenization, and Manny Pacquiao is one of their big investors and backers. Almost done here, guys. Reputation and reward tokens. So these are issued in acknowledgement of some sort of achievement or a status level. Typically, these are non-tradable. So you can imagine tokens being distributed by an authoritative body if you have sort of an educational accomplishment, an employee accomplishment, a professional licensing. They also are kind of very related to the idea of sort of gaming and kind of creating behavioral systems for people. So the example I give here is Numerai. And what they are is they are a prediction market where they allow data scientists to submit different algorithmic models for algorithmic stock trading, and they run weekly contests to see which data scientists have the best models over a period of time. And in order to participate, you have to use the Numerai token to sort of stake and kind of buy your way into the system. And if your model outperforms the rest of the participants, you get more Numerai back in return. So the Numerai really aren't like functionally useful outside of this, but for those that have accumulated a lot of Numerai, it serves as a reputational status in the sense that they've consistently beat out other data scientists at this game. Two more. Non-fungible assets. So most of the tokens that are currently built out are fungible in the sense that they are, sort of interchangeable and replaceable, right? So one Bitcoin is one Bitcoin, just as $1 bill is the same thing as another dollar bill. We've seen recently, specifically with Ethereum's launch of the ERC-721 contract, non-fungible tokens. So these are tokens that actually have unique characteristics for each sort of asset. And these would be especially useful for games and VR. So you guys might be familiar with CryptoKitties. This was kind of like a faddish phenomenon that took off a couple months ago. And so basically these are just like stickers of cats. Each one was unique. Each cat had its own sort of capacity to breed other cats. And it turns out there's people online that like cats, and there's people online that like crypto. And there was actually a large intersection of those two markets. Because the CryptoKitty market, had kind of a boom phase. And so some of these cats were selling for tens of thousands of dollars. If you had a cat that was like particularly adorable and also like particularly proliferate in its breeding habits, it would be very valuable because then you could breed more adorable cats and sell them to people. There is now a recession in the CryptoKitty market. Sorry to report. What's really interesting here is that, so the company behind CryptoKitties actually just raised $12 million from Andreessen Horowitz, Union Square Ventures. And what's interesting here is the idea of sort of cascading digital ownership. So you see here this picture of a cat wearing a hat. So that hat is also an ERC-721 token. It's a non-fungible token. So that cat, that unique cat, uniquely owns that hat. And so you may own the cat, but the cat owns the hat. And if you were to sell the cat, the hat would move with it, right? And then if a zombie were to come into the picture and eat the cat, right, you can see kind of where this is going. So the idea of having sort of interoperability across fungible, non-fungible digital assets, that's pretty remarkable. And we're starting to see some experimentation around that. So the final one here is I want to talk about multi-token systems. So this is not like a particular type of token model, but I think this is a big trend that's happening in the space, which is that essentially we have a number of systems. As blockchain entrepreneurs become more sophisticated in terms of governance and in terms of trying to use tokens to incentivize the behaviors of certain stakeholders, they're actually deploying several tokens at once that are working in coordination of some higher level, system level objective. So the example I give here is Basecoin, and it's actually quite timely because literally last night, or I guess maybe 2 nights ago, the news broke that they had raised $125 million. And I'm not at all surprised by that. So what Basecoin is trying to do is they're trying to build a stable coin. So in contrast to the cryptocurrencies of today that are wildly volatile, they want to build a coin that's stable. And that would have tremendous application for crypto traders that want to hide out from volatility or lock in profits. Obviously for e-commerce, right? It would have use for developing countries or countries where they've got sort of failed monetary systems, and we can kind of give them a virtual opt-out. So I think stablecoins could be absolutely huge. The way Basecoin enables a stablecoin is through a 3-tiered token system. So they actually have 3 different coins. One is the Basecoin, which is the actual cryptocurrency itself. Now, they have to adjust supply of the Basecoin so that it meets demand. And if demand drops for the coin, then you need to have an instrument for pulling supply out of circulation to recalibrate supply and demand. So they accomplish that through the second token, which is base bonds. So the idea there is that they will issue bonds and they will adjust the yield or the payout of the bond in accordance with how urgently they need people to sort of lock up their tokens. But if people buy the bond, they basically spin some Basecoin, which takes it out of circulation. But later on in the future, Basecoin will produce more Basecoins, which gets paid out to the bondholders. So they will earn a profit in the future, presumably. The third token is base shares. So if demand is increasing, they have to increase the supply of the Basecoin token. And so they will first do that by paying out the bondholders. But if there's need for excess supply beyond what the bondholders require, then they would issue those Basecoins to base shareholders. And my suspicion is that they sold off claims to the base shares because the people that put up $125 million are betting that they just bought a piece of a virtual central bank that could be worth trillions of dollars one day, right? In which case, that could be an incredible investment if they succeed. Okay, so just to recap here, right? We've got cryptocurrencies like Bitcoin, utility tokens that power network functionality, settlement tokens that are used to process payments and settle transactions, security tokens that grant ownership claims to financial instruments, asset tokens that represent real-world assets, membership tokens that unlock special privileges, reputation reward tokens, non-fungible assets, and then you can mix them all up and create multi-token systems. So that is what a tokenized economy could look like. I'll skip these last slides and we'll just go towards questioning. Anybody have some questions? Yeah.
So I wanted to understand how valuation would work in a tokenized economy. So like if they're like right now everything is basically still valued in USD or whatever like token or currencies we mentioned, because like that functions as a store of value, right? There's something we can compare apple to apple. If we have like millions of different tokens, then like whether I have to keep track of the valuation of different tokens in order to know whether I should spend something on like certain activities or not. Like yeah. I could imagine it would be very hard for me to keep track of like how much is it to use a babysitting currency, babysitting token. Gotcha. or like passing a car like token, like yeah. Like how valuation would work in that sense.
Okay, so the question was, how do we value these tokens, right? The honest answer is like, we don't know yet, right? I mean, go back 20 years ago, how do you value a website? People didn't know, right? So they would just value it based off of eyeballs, and that allowed to justify some really crazy valuations. We're going through a similar discovery process now. I will say this, there's a lot of tokens that don't need a trading pair valuation, right? So if you have that token in your classroom that gives you credits for peer review, who cares what it's worth in dollars? Like you've got currency in that system. Same thing with the babysitting cooperative or the poker room, right? For those tokens that do need a trading pair, their primary trading pair is not the US dollar, it's actually Bitcoin, right? So Bitcoin today is the king of crypto. And if you go into the altcoin markets, it's all trading off of Bitcoin. So the common denominator is BTC, which of course is volatile in its own right, but that's where people are measuring their profits and their gains off of. That's the unit of account. Does it create usability problems, right? Like, is it really fair for us to ask consumers to have a virtual wallet with like dozens of different coins? I don't know. We'll find out, right? Like, I think whoever does figure that out and solves it for the better, that could be a huge business opportunity right there. Yes.
Analogy to the protocols, HTTP. Like those protocols succeeded was because they had the network effect in play, right? Like companies.
Not initially.
Well, take for example Facebook's super growth. Any of those companies' growth patterns. The reason why they all had that initial phase of growth was because you had friends of friends in that platform. Can you tell me in terms of crypto, how would that play? Because there seems to be a lot of dilution. And then would there be a network winner? Would there be a network effect in play here? And would there be a clear winner, or it'll always be a diluted market?
There's definitely going to be network winners. If we go back 15 years ago, Facebook was not the only social network out there, right? There were dozens and dozens of other ones, and Facebook beat them all. Similarly, I think we're going to see the same thing play out with smart contracts, right? We're not going to have 20 different smart contract platforms. We might have a small handful, and whether it's Ethereum or Neo or EOS, we don't know who's actually going to win that market, but they're going to win because of network effects. So if you're deploying a smart contract, you want that contract to be usable, and you want it to be interoperable with other contracts, and you start building this entire virtual experience, and you're not going to go to the market where you don't have the users or you don't have the smart contract infrastructure. So I think it's going to play out the same way it has in the past, right? Those that can build the best technology, amass a user base fast enough, develop their stack, they're going to have an advantage over those that are moving slower. Yes.
So you mentioned smart contracts and dApps versus protocol. It seemed to suggest that I guess like the latter has a lot more value over the longer term. Can you talk
The
more
protocols.
about Can you talk more about how you see that playing out?
I think there's going to be businesses that are basically decentralized applications, and they're sort of offering a collection of smart contracts that could be very valuable in their own right. So I'm not trying to dismiss that area of innovation, but the fat protocol theory is essentially that the base fabric of the infrastructure that allows you to sort of operate, that's where you're capturing the value, because that's mediating the commercial exchange. And so every layer up the stack is going to be able to sort of extract fees from the transaction. So when you get to the very top of the stack, how much is left over? That's fat protocol theory. It hasn't been proven, but that's sort of a school of thought in the space.
I have a question from the remote folks.
I'll get back to you.
I'm just go ahead and read this. Can you speak to the blockchain computation and energy consumption? Are there any mechanisms that will keep this from getting out of control if cryptocurrencies expand?
Yeah, it's a real problem. It's a legitimate problem. So for those that aren't super familiar with it, there's particular consensus algorithms that govern how the network of computers interact with each other. Bitcoin's is called proof of work, and it's very computationally intensive, right? So the entire computing network that's supporting Bitcoin is consuming the electrical capacity of like small countries at this point. So if it gets bigger, it can get out of hand. The problem with Bitcoin, this is really a social problem because we can't turn it off. Bitcoin's never going to be turned off. Like my kids will have Bitcoin, and maybe it's like a fraction of Bitcoin and it's worth a lot, or maybe it's like Dogecoin and it's not worth anything. Fortunately, so I think we have a couple of options. We can, as a society, make a decision as to sort of what world we want to live in, and do we want to empower these energy-intensive technologies? And if not, what are the alternatives? And there is a lot of computer science work to build systems that are less power intensive. So Ethereum, for example, is in the process of switching its algorithm from proof of work to proof of stake, which promises to be much more computationally efficient. So yeah, Bitcoin's a problem in that regard. But fortunately for us as consumers, we have the choice to determine sort of which platforms we want to interact with, and we should be mindful of energy consumption along the way. Well, let's not even start about IOTA. IOTA, stay away from IOTA. Yes. Oh, I'm sorry. I promised you back there. We'll get to you next. Yeah.
So when it comes to companies starting to take cryptocurrencies as currency, like in retailers, stuff like that, there's an issue where all of a sudden everything's very transparent. So like Apple doesn't want you to know exactly how much money each one of their stores make, but if they accept money in Bitcoin, all of a sudden right? Do you think that all of a sudden that information is going to become more public, or do you think retailers are going to really fight back and say like either issue their own coins or just use Monero or something that's really privacy focused?
Yeah. So I mean, if they're using Bitcoin, those transactions are public, right? So right now today, people can go and see, and they can find that this address corresponds to this merchant. Here's their activity, and obviously that's information they would prefer to keep private. So they have a few options. They could use a privacy coin like Monero, or I would expect actually a class of businesses to emerge that will solve for that problem. So you could almost expect, and this kind of moves away from the purpose of decentralization, but you could almost envision sort of like a centralized intermediary that collects the payment. So they're sort of aggregating payments from all these merchants, and then on the back end, they're using sort of over-the-counter markets to deliver. That's a possibility, right? So we'll see. I mean, all of these problems that are preventing adoptions, like these could be billion-dollar startup opportunities, right? That people can solve. You had a question? Yeah.
Summary slide of the.
Oh yeah, absolutely. If I can turn my computer back on. Here we go. Yeah, here we are. Yes.
Yeah. First of all, thanks for your talk.
Thank you.
It. What happens when these immutable ledgers are used to store illegal content and it becomes illegal to run a node?
Yeah, that's another social problem that we have, right? So, in the case of Bitcoin, I almost hate to bring this up, but since we're on the topic, years ago, so Bitcoin, just like in the Bitcoin blockchain, you're just encoding messages, right? And you can do images as well. And somebody encoded images of child pornography years ago. So everybody who is running a full Bitcoin node is by default storing child pornography, right? And because of the nature of the blockchain, we can't undo that, right? We can't go back and scrub it out. It's in there in perpetuity. I don't have an answer to that, but it is a problem. Yes.
Any Intuit projects that you are planning that you can share with the team?
I'm sorry?
Any Intuit projects in terms of tokens that you guys are planning?
So not so much in terms of tokens. I've been advocating that we should think about maybe launching a token. And I do think that we will see maybe in a year or two some corporate sponsoring their own tokens. I think that is actually an inevitability. For us, we just have to be very thoughtful in terms of what the purpose of the token is, what's the system around it, what are we trying to incentivize. I think in our case, we wouldn't be launching tokens for the purposes of raising capital. If Intuit wants to finance a project, it can do that. But in terms of driving adoption, it could be interesting. So no plans to launch tokens as of yet, but we'll see how that plays out. Yes.
So question from online. Any insight on how to judge whether or not a token is needed for a business?
Yeah, I mean, I think you just have to really figure out, so all of these different use cases, these are different ways of using a token, right? So I would say first you would want to classify the token. And then you want to think through the classification. What is sort of the economic value proposition there? So for example, a membership token, I don't think is very useful unless there's really high demand for people to unlock privileges in that community. So for that reason, I'm not very bullish on coins like Stalled or Dragon. A utility token is only going to be as valuable as the network that emerges around it, right? There's people that have proposed different ways of sort of financially modeling this stuff. It's all proposals at this point. That's not really what I do. But I think if you want to sort of like think long-term about what you're investing in and you want to sort of invest in coins that are going to survive the bear market, you have to start with a taxonomy and to sort of understand the distinct value proposition of the token, and then sort of just, kind of from first principles, reason through that.
Thank you very much. That's all we have time for today. Thank you everyone for joining us. Thank you to the folks online.